What if I told you that the financial system you trust with your hard-earned money isn't just a tool for commerce, but a carefully designed mechanism that keeps most people trapped in cycles of debt, dependence, and uncertainty? What if the very institutions claiming to serve your interests are, in reality, built to extract wealth, enforce compliance, and preserve power for a select few? The mystery is unsettling. How is it that millions of people work tirelessly, yet remain financially insecure? How is it that credit, loans, and even wages can feel like chains rather than empowerment? Today, we're going to explore the hidden architecture of financial systems designed to control, constrain, and keep ordinary citizens perpetually dependent. This is not a conspiracy, it's history, economics, and psychology woven together in ways most people never fully understand. The story begins not with banks, not with credit cards, but with the very idea of money itself. For thousands of years, humans relied on tangible assets, gold, silver, and other commodities to exchange value. These systems were limited, slow, and imperfect. But they had one inherent check: scarcity. No single entity could create unlimited wealth from thin air. Then came the shift: paper money and state-backed currency. Governments realized that trust could replace intrinsic value. If people believe the currency is valuable, the government doesn't need to back it with gold or silver. With this shift came an opportunity. Control over money became control over citizens. Central banks emerged, financial institutions gained unprecedented influence, and credit systems were constructed to guide spending, debt, and accumulation. History is full of pioneers in this system. The Medici bankers in Renaissance Italy, the Bank of England in the 1600s, and the Federal Reserve in the 20th century. Each innovation promised stability and growth, yet each also expanded the capacity for debt-based control. The trap begins subtly. Governments and banks realized they could incentivize borrowing while discouraging saving. Credit cards, mortgages, student loans, auto loans, they were marketed as freedom and opportunity. But in reality, they created predictable cycles of dependence. Interest compounds, fees accumulate, and the borrower remains tethered to a system they never fully control. Take the example of compound interest. Albert Einstein allegedly called it the eighth wonder of the world. That's because when it benefits institutions, it can turn small debts into life-altering obligations. This system doesn't just extract money, it shapes behavior. Citizens are trained to spend, borrow, and invest according to rules designed to enrich the few at the top. By the 20th century, debt had become ubiquitous. Governments borrowed to fund wars, infrastructure, and social programs, often issuing bonds purchased by banks and wealthy investors. Citizens were simultaneously encouraged to take loans for homes, cars, and education. This dual-structure state debt and personal debt created a financial ecosystem where ordinary people were interdependent with larger systems they could barely influence. Economic crises, recessions, and inflation became tools, intentionally or not, that ensured compliance. Those who tried to opt out, who avoided borrowing or saving in the approved way, were marginalized or excluded from growth opportunities. Historically, we see repeated patterns. Hyperinflation in Weimar Germany, credit dependency in post-World War II America, and banking crises in emerging markets. In each case, the same mechanisms, credit, interest, and central control, shaped outcomes, often to the benefit of a few and the detriment of the majority. The system is not infallible. Crises occur when debt levels outpace economic growth, or when trust in financial institutions collapses. The 2008 global financial crisis is a prime example. Subprime mortgages, derivatives, and complex banking instruments created enormous risk. Ordinary citizens lost homes, savings, and security, while governments and banks implemented bailouts to preserve systemic stability, effectively rescuing institutions while leaving individuals trapped. The breaking point is always the same. Ordinary people are left with the consequences of risk they never took. Wealth is concentrated at the top, while the majority absorb losses, debts, and instability. These failures reveal that the system is not neutral, it is structured to protect power, and its failures often reinforce existing hierarchies rather than dismantle them. The consequences are profound. Millions remain in cycles of minimum wage employment, credit card debt, student loans, and mortgages. Savings are eroded by inflation. Pensions and social safety nets are often inadequate. Financial literacy, while promoted as a solution, rarely addresses the structural forces at play. Globally, inequality has reached historic levels. The richest 1% control more wealth than the bottom 90% combined. Economic mobility is shrinking. People work harder for less security, and even the appearance of true loans credit. Investments is often a mirage designed to maintain the illusion of freedom while keeping systemic control intact. Attempts to fix the system often fail for the same reason. They address symptoms, not design. Financial literacy programs help people navigate the system, but they rarely change power structures. Debt forgiveness and stimulus packages provide temporary relief, but the underlying incentives, compounding interest, centralized control, and systemic extraction, remain intact. Alternative systems like cryptocurrencies, peer-to-peer lending, and decentralized finance offer some relief, yet they operate alongside, rather than replacing, the entrenched structures. Governments, regulators, and institutions are adept at integrating these innovations while preserving control. The cycle continues. Today, the pattern is unmistakable. Credit scores determine access to housing, employment, and loans. Governments issue endless national debt, funded by central banks and private investors. Financial crises occur regularly, reinforcing dependence. Wealth concentration continues to rise. Ordinary citizens are increasingly aware, yet their options remain constrained by infrastructure, regulations, and systemic inertia. Shocking data highlights this scale. Global household debt exceeds $55 trillion, while at the top 1% continues to accumulate wealth. Meanwhile, central banks hold unprecedented influence over monetary policy, interest rates, and liquidity tools that directly shape the economic fate of billions. Debt is not just an economic tool, it is a mechanism of power. Understanding how it functions is essential for any citizen seeking autonomy. Financial literacy alone cannot free individuals from systemic constraints. Awareness must be coupled with strategic action, including diversification of income, investment in tangible assets, and understanding macroeconomic forces. Systems evolve, but so do methods of control. Technology, innovation, and decentralized tools can shift power, but the underlying architecture often adapts, preserving influence for those at the top. The most dangerous assumption anyone can make is believing the financial system is neutral. Every policy, regulation, and product is designed, intentionally or not, to maintain stability, enforce compliance, and protect entrenched power. Ignorance may feel safe, but it is costly. True understanding requires looking beyond the surface, questioning assumptions, and preparing for systemic realities before crises strike. If you want to explore the hidden mechanisms behind global finance, debt, and economic control, make sure to like, subscribe, and hit the notification bell. Each week, we dive deep into the structures shaping wealth, power, and opportunity around the world. Because in the world of finance, what you don't know can cost you far more than what you do.